You clicked on this video because you want to know if timing the market is actually possible. You are probably worried that you are missing out on gains while waiting for the perfect dip. The real problem is that your brain is trying to solve an impossible equation. By the end of this video, you will understand why the single most powerful move you can make is simply to stay in the market, even when it feels like the wrong time. Here is the thing about the stock market. Most people treat it like a puzzle where you need to find the perfect solution. They believe there is a specific moment where the price is low enough to buy and a specific moment where the price is high enough to sell. They think that if they can just predict that moment, they will beat the average returns. This is the perfect timing fallacy. It is a seductive idea because it promises control. It suggests that your intelligence or your analysis can outsmart the collective behavior of millions of other investors. But the data tells a very different story. Consider how the market actually moves. It is driven by human emotion, news cycles, and unpredictable events. Sometimes the market jumps up 2% in a single day because of a surprise economic report. Sometimes it drops 3% because of a geopolitical scare. These moves happen without rhyme or reason. They are not predictable. If you are trying to time the market, you are essentially betting that you can predict the future. You are betting that you will know exactly when that 2% jump is coming so you can be there to catch it. The problem with this strategy is not that you cannot predict the future. The problem is that the market rewards you for being present, not for being right. Let me explain why missing just a few days can destroy your entire strategy. Over a 10-year period, the S&P 500, which tracks the largest companies in the United States, has historically returned about 10% per year on average. This number is not magic. It is the result of compounding gains over thousands of trading days. Quick resource note. I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Now, imagine you try to time the market. You sit on the sidelines waiting for the perfect entry point. You miss the days when the market is down because you think it will go lower. You also miss the days when the market is up because you think it is too high. You think you are being smart by avoiding the volatility. But here's the critical insight that changes everything. The best days in the market do not happen randomly. They happen in clusters. They often occur right after the worst days. If you are out of the market during those two best days, you miss the explosive growth that drives the annualized return. Research shows that if you miss just the two best days of the decade, your 10-year annualized return drops from 10% to roughly 6%. That is a massive difference. 6% is still a good return, but it is significantly less than what you could have achieved by simply doing nothing. You have lost 40% of your potential gains because you tried to avoid the noise. This is where the wisdom of the crowd comes into play. When you try to time the market, you are acting against the collective wisdom of millions of investors who are constantly buying and selling. You are trying to filter out the noise, but the noise contains the signal. The market is not a perfect oracle, but it is a mechanism that aggregates information. When you step out, you are not just avoiding risk. You are also avoiding the upside that comes from that aggregation. You are essentially saying that you know better than the entire market, even though you are admitting that you cannot predict the future. Think of it like a system architecture. If you build a system that tries to optimize for zero downtime or perfect entry points, you introduce catastrophic complexity. You create latency. You create points of failure. The system becomes so sensitive to every little fluctuation that it stops working. A better approach is an always-on architecture. In finance, this is the buy and hold strategy. It is simple. It has minimal state. It requires no constant decision-making. It provides the highest availability for your capital. The anxiety you feel about missing out is a natural reaction. Your brain is wired to avoid loss. It sees the market dropping and screams at you to get out. It sees the market rising and screams at you to get in. But this anxiety is a trap. It is designed to make you act when you should be doing nothing. The market is not a game of skill where the smartest person wins. It is a game of endurance where the person who stays in the game the longest wins. There is a nuance here that is often missed. The market is not perfectly efficient. It can be biased. It can be irrational. But for the average investor, trying to correct those biases is a fool's errand. The cost of trying to fix the market is always higher than the benefit. Every time you try to time a move, you introduce transaction costs, taxes, and the risk of being wrong. You are adding friction to a system that works best when it runs smoothly. The real edge is not in your ability to predict the next move. The real edge is in your ability to ignore the urge to move at all. It is in your ability to accept that you will not know when the market will go up or down. It is in your ability to trust the long-term trend over the short-term noise. When you accept that you cannot time the market, you free yourself from the paralysis of waiting for the perfect moment. You realize that the perfect moment does not exist. The only moment that matters is the one where you are already invested. So, the next time you feel the urge to sell because the market is dropping, or the urge to wait because you think it will drop further, remember the 2 days. Remember that missing those 2 days costs you 40% of your potential gains. Remember that the market is not a puzzle to be solved. It is a force to be harnessed. The only way to harness it is to stay in the harness. Stop trying to be the hero who times the market. Be the investor who simply stays there. That is the only edge that matters. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.